$700 billion. Gone. In just 1 year. Not because of a world war. Not because of a global pandemic. But because one of the fastest growing financial markets on Earth suddenly collapsed. Millionaires became bankrupt overnight. Billion-dollar companies disappeared in days. And one trusted crypto empire turned out to be one of the biggest financial scandals of the decade. So what really happened? And how did the crypto winter of 2022 wipe out so much wealth so quickly? Let's find out. At the end of 2021, it felt like crypto had entered a new era. Bitcoin had reached an all-time high of nearly $69,000. Ethereum was breaking records. NFTs were selling for millions. Crypto exchanges were buying naming rights to sports arenas. Celebrities promoted digital assets. Professional athletes accepted salaries in Bitcoin. Every week, another startup promised to revolutionize finance. The message was everywhere. Crypto wasn't just the future. It was replacing the financial system itself. Millions of first-time investors rushed into the market. Some invested their savings. Some borrowed money. Others even quit their jobs to trade cryptocurrencies full-time. Confidence was at an all-time high. But beneath all the excitement, the foundations were becoming dangerously weak. The boom had been fueled by years of low interest rates and easy money. During the pandemic, governments injected trillions of dollars into the global economy. With cash flowing everywhere and bank savings paying almost nothing, investors searched for higher returns. Stocks soared. Technology companies exploded in value. And crypto became one of the hottest investments on the planet. Money poured into every corner of the industry. Crypto exchanges expanded rapidly. Lending platforms promised extraordinary returns. New blockchains appeared almost every month. Venture capital firms invested billions. The entire industry seemed unstoppable. But many companies were taking enormous risks behind the scenes. Instead of simply holding customer assets, they were lending them out. Borrowing against them. Using leverage. And chasing increasingly risky investments. Some platforms promised annual returns of 15, 18, or even 20%. Those numbers sounded incredible. But they raised an important question. Where was that money actually coming from? In many cases, it wasn't coming from productive businesses or sustainable revenue. It depended on one thing. Crypto prices continuing to rise forever. As long as prices kept climbing, the system appeared healthy. But if prices started falling, everything could unravel. That moment arrived in May 2022. A project called Terra had become one of the biggest success stories in crypto. At the center of its ecosystem was a digital currency called UST. Unlike traditional stablecoins backed by real dollars, UST relied on computer algorithms and another cryptocurrency called Luna to maintain its value. For months, the system appeared to work perfectly. Billions of dollars flowed into Terra. Investors were attracted by nearly 20% annual returns through a lending platform called Anchor. Many believed it was one of the safest opportunities in crypto. Then confidence disappeared. Large investors began withdrawing money. UST lost its $1 peg. Panic spread across the market. Investors rushed to sell. As more people sold, the system entered a vicious cycle. Luna's price collapsed. UST fell even further. Within days, more than $40 billion in market value had vanished. One of crypto's largest ecosystems had effectively disappeared. The collapse shocked investors around the world. But Terra wasn't an isolated failure. It exposed a much bigger problem. Many of the largest companies in crypto had become deeply connected. When Terra collapsed, the losses spread rapidly. Crypto hedge fund Three Arrows Capital had massive exposure. It couldn't repay billions of dollars in loans. Lenders suddenly faced enormous losses. Several companies froze customer withdrawals. One of them was Celsius. Millions of customers suddenly discovered they could no longer access their own money. Confidence across the industry collapsed. Investors rushed to withdraw funds from every major platform. Liquidity disappeared. The dominoes continued falling. But the biggest shock was still ahead. FTX had become one of the most respected names in crypto. Founded by Sam Bankman-Fried, the company grew at incredible speed. It signed sponsorship deals with professional sports teams. It partnered with celebrities. It appeared before lawmakers. Investors valued the company at more than $30 billion. Many believed FTX represented the future of responsible cryptocurrency trading. Then everything changed. Reports revealed that customer funds had allegedly been transferred to Alameda Research, a trading firm closely connected to FTX. Those funds were reportedly used for risky investments. Customers immediately panicked. Billions of dollars were withdrawn within days. FTX didn't have enough money to meet those withdrawals. The company collapsed almost overnight. It filed for bankruptcy. Millions of customers lost access to their funds. The collapse became one of the largest corporate failures in modern financial history. Confidence across the crypto industry reached its lowest point. Bitcoin fell more than 70% from its all-time high. Ethereum suffered similar losses. Thousands of smaller cryptocurrencies became nearly worthless. Crypto companies laid off tens of thousands of employees. Investment funding dried up. Projects shut down. The excitement that had defined the previous 2 years completely disappeared. This period became known as the crypto winter. But despite the devastation, the story didn't end there. Every major financial crisis leaves behind important lessons. The dot-com crash eliminated hundreds of internet companies. Yet companies like Amazon survived and became global giants. The financial crisis of 2008 transformed banking regulations. And the crypto winter forced the digital asset industry to confront its biggest weaknesses. Investors demanded greater transparency. Exchanges introduced proof-of-reserve systems. Governments accelerated efforts to regulate digital assets. Institutions became more cautious. The focus slowly shifted away from speculation and toward real-world applications of blockchain technology. The crypto winter of 2022 wasn't just another market crash. It was a reminder that financial markets are built on confidence. When confidence disappears, even the largest companies can collapse. Even billions of dollars can vanish. And even revolutionary technology cannot protect investors from poor risk management, excessive leverage, and blind trust. In the end, the biggest lesson wasn't about Bitcoin. It wasn't about blockchain. It wasn't even about cryptocurrency. It was about one timeless rule that has shaped every financial market throughout history. Trust takes years to build. But it can disappear in a single day.